Okay, in this short video, I'm going to review the new Power Trading Suite for the Ninja 8 platform. This is version 1.0. This is going to be the version that we launch with, and we'll go over the basics. Once you import the Power Trading Suite into the Ninja 8 platform, and let's say you right-click on your chart and you go to indicators, you're going to see up towards the top, you're going to see this little folder, PTSuite. And then when you double left-click on that, you'll see the list of indicators. So we're starting off with these 4 basic indicators. Power levels is where we get the opening price level. We can set, let's say, like a 5-minute time range. We can get pre-market ranges included. That's where you're going to find the VWAP. The power pullback indicator is the new trade alert indicator that we're going to be discussing in this video. And then we've got power targets, which compute targets for the session, and you can set the beginning of your session, and depending on the range, it's going to go ahead and compute targets that we can work with. And then we have the power volume. So I'm going to be mostly reviewing this power pullback indicator here in this video. Now, the new power pullback indicator is designed and calibrated to work internally. So in other words, it doesn't matter what chart you put it on. You're always going to get the same alerts and alert levels. However, you're going to want to put it on a little bit faster time frame. With this particular trading alert indicator, it doesn't make sense to put it on a 5-minute chart. It's too slow. You need something a little bit quicker. So the highest time frame I recommend you use is a 30-second chart. Now you can put it on a range bar chart. With the ES, I recommend, let's say, like a 4-tick range. NQ, maybe a 6-tick range. YM, 8-tick range. You can put this on a Renko bar chart, so on and so forth. The volume and tick charts as well, but keep the levels down. So for instance, an ES tick chart, you'd want to put it on, let's say, like a 500 tick chart. Okay, the chart you put the indicator on does not have any bearing on the alerts. Okay, just keep that in mind. But you do want a quicker time frame to work with. Now let's say in this example here we're watching a 30-second basic bar chart, and we're starting to see some momentum in the market, and the indicator detects a potential trade setup, trade alert. And so what you're going to see initially is you're going to see a bar come with a green background. That is your alert bar. That's the bar where the indicator actually triggers. Now, right at the exact same time, it's going to generate a range. And in the case of a long, the top of the range will be green and the bottom will be maroon. Now, not to get confused here, when you get this alert, you will see the price outside of the range. Okay, that's how it's calibrated. This is your pullback area. Okay, so don't get confused about that. Don't think that something is late. It's not. You will always see the alert bar will be outside of the range that gets generated, because this is a pullback zone. Now, 50% of the time, we're going to see price continue on from the point of the alert bar. It's not going to pull back. It may wiggle around a little bit, but then it takes off and keeps on a trucking. So 50% of the time, price just keeps moving in the direction of the initial momentum. The other 50% of the time, we're going to see price from that point, we're going to see price pull back to the top of the range. Okay, now this is the way the indicator is calibrated, and with this we can play this price movement in various ways. The first and the simplest way is when we get an alert bar, we just take an entry right on the close of that bar, and we set our stop on the far end of the range. If price wiggles around and continues on, we can continue to trail our stop behind price, and we're just in one trade. Now, the other way we could look at this is we get the alert bar, and then we could wait, not take an entry here, but wait for a pullback towards the top of the range, and we take our entry down here. But now remember, one of the issues is that 50% of the time price is not going to pull back. So you can sit here and wait for the pullback, and then price is going to just keep on going, and you're not in the trade, right? So one way we can do this to hedge our bet is to play a double entry type of position. When we get the initial alert, we go in on one contract, let's say, right on the alert bar, and then we immediately put a limit order in down right at the green horizontal line for another contract. So price comes down, and we have a second buy point. Now, once you get filled on these two positions, then your average contract price is going to be somewhere in the middle. One way I recommend you play this is 1 and 2. So for instance, a 1 and 2 ratio. Take a contract on the alert bar and then put a limit order in for double that down at the top of the range. All right, and then your stop would go for all three contracts would go down below the range. So what we're looking for then is we're looking for the initial momentum to pick back up and follow through, and then as price moves in our favor, we can consider taking these two off, and then that's going to get this initial contract to a virtual break even though our stop loss is not actually at our entry price. Taking two off quick puts this at no risk, and that can be held for much bigger targets then, or with trailing stops, so on and so forth. Right? Now, obviously, one of the scenarios is you get filled on the first position, second position, and then the price fizzles and just keeps going and hits the full stop. That's going to happen. However, you're going to see pretty high frequency. We get good follow through, and we get an opportunity to pull that second position off quickly on a bounce, and then even if the whole thing fizzles over time, at least we're at break even then on the whole position. Okay, we got out break even. So there's different methodologies of figuring out where you want to take these two off. One is to look for the first move that's past the entry bar, the first entry bar, and then pull those two off. You may spot some various targets on your chart. The targeting indicator, we might be close to one of the targets. You pull those two off at the target. So we'll be talking about those mechanics. But this basic little strategy here is great because it kind of hedges your bets. Once we get the initial alert, you go in with a 1, and if we don't pull back, well, you're in the trade. 50% of the time, the trade will go follow through and not pull back towards the top of the range. When we do get filled in the second position, then we also have high frequency follow through on that, and we're loaded up with even more contracts, and we can pull some off to get us to a break-even standpoint. All right, so let me show you a real example here. This is running on the Ninja 8 replay feature. Again, we're on a 30-second chart, and this pink line here, that is the VWAP. So you're going to get the VWAP. You can turn that on in the power levels indicator. Now, the pullback indicator knows the level of the VWAP by itself, so you don't need to turn it on. But if you want the visual, you can go into that power levels indicator and turn that on. So what we're going to do is let's go ahead and just play an alert here and see how it follows through.
Entering trading zone long.
Okay, so you can see we got our pullback alert range, and this, again, like I said in the graphical example, is that your price bar is going to always be outside the zone, the range. And what we're looking for is a potential pullback to the top of the range. Now, like I said, price from right here can take off and move forward and never pull back. 50% of the time it does that. So what I'm going to do here is I'm going to go ahead and just take an entry at the market on that alert.
Order filled.
Okay, so what I'll do then is I'll change my order quantity and go ahead and place a limit order right above the top of that range, right above the green dotted horizontal line. Okay, and so we are looking to potentially get filled on a pullback. Now, right away, what we're going to want to do is put a stop in, a full for a full stop out below the range for all three of those contracts. Because if we run down there, we're going to be filled on that second entry as well. So we're going to set that stop. Okay, and then the next thing we can do is, next thing we want to do is change the order quantity back to 1, and then we can put a target out there for the first contract that we're filled on, right, in case we don't get filled on the second one. So now we got all the bases covered. You can see that we filled on one contract on the alert bar. We have a limit order in for 2 above the top of the range, and then our full stop is down below the range for 3, and then we've got our target on 1. I just picked an arbitrary level up here because we're just getting the order in, and then we're waiting to see how this plays out with the second contract. Now, in this particular example, this was kind of a tight little range here, but you can still play it the same way.
Order filled.
All right, and so now what we want to do is we want to go ahead and get an order in right away for taking 2 off. Okay, the 2 that we just filled on. And so again, we can just pick a level up here somewhere to take 2 off, and then that'll get our first contract at break even. Okay, so now you can see that we have a trade setup here, bracketed in real nicely. We're filled on 3. We have our full stop down below the range. We've got a quick target to pull 2 off. And remember, the whole idea of doing that is then that gets this remaining contract to a virtual break-even point. So when we hit here, we're going to change that stop to just 1 contract, and we can actually move it up below this little pivot here. So I'm just kind of like redoing the pricing here now that we're filled on 2. Now that we're filled on 3, we're going to try to maybe get a bigger run.
Order filled. Order canceled.
I'm going to change that to a stop for 1 contract now, and then I can just stick that below the last little pivot there that I see on my 30-second chart, and we're off to the races. Basically, we're at a virtual break even, and we're going to let that remaining contract run out and see if we can hit a bigger target. Okay, and as you go, as you see more and more bars where the low is higher than your entry, then you can go ahead and actually move your stop up above your entry point. And the nice thing about a trade like this is that once you get to that break even where you can't lose, you can be patient and let the market work.
Order filled. Order canceled.
Okay, and then you always want to make sure that you clean up any orders that are still in the market there. So there's an example of a long entry that occurred, and one way to play it off of this alert. All right, next let's go ahead and take a look at a short example. And you can see here the market's a few hours into the session. We actually have our power targets on, so there's one of the target levels. And you can see our 30-second chart's actually kind of cruising down towards that target. All right, on this particular day we already had multiple alerts that followed through, and so this is going to be another example where we can see how to play this one. So
entering trading zone short.
okay, so you can see we got our alert and the range, and on the short side you're going to see that the maroon horizontal line is up at the top, and then you've got a red dotted line down at the bottom. So that's one of the ways you know it's a short. Plus you've got the red alert bar background there. Now in this particular example, notice that the alert bar actually closed right at the pullback zone. Okay, so what do? Well, remember the alert indicator gives you alerts of like developing and impending momentum and follow through, right? That's what it's designed to do, and it's calibrated to give us a pullback zone. So in this example we actually already kind of pulled back into it. So what I'm going to do here is just take the entry with 2 contracts.
Order filled.
All right, and so I'm filled there with 2 contracts, and immediately I'm going to go ahead and stick a buy stop market order up above the range. And in this example, what I can do is, because I got that target right there at 34 level, I'm going to go ahead and put my first buy limit, because that's my visual reference point of where price is likely to go. So I'm going to pull half off at that level.
Order filled.
Okay, and so we just hit the T1 there and pulled half off, so I'm going to go ahead and adjust my orders. I'm going to go ahead and cancel.
Order canceled.
I'm going to go ahead and cancel that one for 2, set the one for 1, and then I'm going to go ahead and put a new limit order way down at the second target there. All right, and now because I hit the T1 here, and I've got like a little pivot right there, I can pull my stop down just above there, and this is the entry level. So I don't even have to be at the entry level with a stop, but I'm still at a virtual break even. One of the big challenges in trading is that we want to be able to stay in positions to take advantage of the potential movement, and so we've got to give our positions enough wiggle room to be able to stay in. The worst thing in the world is you're in a great trade that ends up following through, but you move your stop to physical break even too quickly, and you get knocked out, and then you're out of the trade, and it goes on merrily in your favor, and you're sitting there on the sidelines. So this little trick here gives us the ability to give us a little bit of wiggle room on the trades. We took some profit, we got wiggle room, but we're at break even, can't lose, and now we can be patient and let the market work. And in this particular example, we went down and filled that second order here, hit that second target. Now, a couple quickie things. You will notice that the range there can only be one range on the chart at a time. So you'll see that at points, if the market shifts and starts moving in different directions, a current range might disappear. Okay, because the markets may be going in the other direction, so it's no longer valid. The second thing is if you're in a trade and the market, let's say in this example, moves lower, you can get a second range. In fact, let's just take a look at what happens there. I'm going to speed it up a little bit, and you can see that a little bit lower here we got another alert right now, but we're already in a trade. So my advice is that don't complicate things or get too greedy. It is possible to use the next alert and the next range as an add-on, but the negative there is you can screw yourself up because you pull your average contract price close to price action, you can just knock yourself out. So that's a delicate balance. So my advice is just ignore the next alerts because you're already in a trade and you're going for a target. Now, if you get an alert like this, you can use the new range as maybe where you want to pull your stop to, right? You can do that. So you're going to notice that you can get more alerts. Now you can see I got it sped up here. So you can see we got a couple more alerts. We went down and actually hit that second target then.